If you're completely new to day trading, the first thing you need to understand is this. People don't lose money because trading is impossible. They lose because they jump in without knowing what they're actually doing. Day trading is a skill. And like any skill, it demands patience, structure, and real understanding. Let's break the foundations in a way that actually makes sense. What day trading really is. Day trading simply means buying and selling within the same day. You're not investing. You're not holding for weeks or months. You're trying to catch short, quick price movements that can last a few minutes or a few hours. Think of it like surfing. The waves, prices move fast. If you don't understand the rhythm, you will fall hard. Your job is not to fight the market. Your job is to read it. 2. What makes prices move before you even touch a chart? You need to know why the price moves up or down. There are only a few real reasons. Asterisk buyers are stronger than sellers' price goes up. Asterisk sellers are stronger than buyers' price goes down. Asterisk both are equally strong. Price becomes choppy and unpredictable. Everything else you hear online is just noise. News, indicators, candles, they all reflect one basic truth. Markets move because of imbalance. Once you understand this, you stop guessing and start reading. 3. Your first goal is not to make money. This is where beginners fail. Don't think about profits in the first month. Think about learning how the market behaves. Asterisk how candles change when buyers are strong. Asterisk how volume spikes before a breakout. Asterisk how price reacts to a support zone. Asterisk how trends speed up or slow down if you don't train your eye. You'll always feel like the market is random. It isn't random. You just haven't trained long enough. 4. The tools you actually need. Ignore the 20 indicators people show in YouTube videos. Start with the essentials. Clean candlestick chart. Asterisk support and resistance zones. Asterisk trend lines. Asterisk volume. When you remove unnecessary tools, the market becomes clear instead of confusing. Clarity is an advantage. 5. The only 3 market conditions you must master. Every chart in the world moves in one of these. 1. Trending up, higher highs, higher lows. 2. Trending down, lower highs, lower lows. 3. Sideways/choppy, no clear direction, traps everywhere. Your job is simple. Only trade when the market is trending. Avoid choppy zones at all cost. This rule alone saves beginners from unnecessary losses. 6. Start with observation, not trading. Open your chart every day. Pick one market, only one. Watch how it behaves in the first hour, the middle of the day, and the final hour. Spend at least 1 week just observing. You can't learn to drive by reading about cars. You learn by sitting behind the wheel. Trading is the same. 7. Your mindset is more important than your strategy. Day trading exposes your emotions. Greed, fear, impatience, ego, these destroy traders faster than a bad strategy. If you feel nervous, angry, desperate, or overly excited, the market will punish you instantly. A calm trader makes better decisions. A disciplined trader survives long enough to succeed. Everyone else quits. 8. What you should expect before making your first real trade. By the end of part 1, you should aim to understand market structure, recognize trends versus fake moves, read candles with confidence, identify clean support and resistance zones, know when the market is dangerous, accept that losses will happen and that's okay, focus on skill building, not profit chasing. If you reach this stage, you're ahead of most beginners who blow their account in the first week. How to prepare for your first real trade. If you've reached the level where you can read trends, identify clean zones, and avoid choppy traps, you're ready to move toward the next stage. This is where day trading becomes more structured and less emotional. Your goal now is simple. Build a repeatable process. 1. Your trading routine starts before the market opens. Most beginners open the chart and start trading immediately. That's a mistake. A trading day starts with preparation. Before the market opens, you should already know the key support and resistance zones for the day, where the strongest trend might develop, areas that will likely trap beginners, how volatile the market might be. You don't want to react. You want to anticipate. This mindset alone separates a disciplined trader from an impulsive one. 2. Marking zones that actually matter. Support and resistance only work when they come from real levels. Good traders look for previous day's high and low, strong rejection zones, areas where price stayed for a long time, zones where big volume entered your chart should look clean. Just 3 or 4 strong zones are enough. More than that creates confusion and hesitation. Clarity gives confidence. 3. How to identify a high-quality trend. A trend becomes tradable only when the highs and lows are consistent, pullbacks are clean, volume supports the direction, price is not bouncing randomly. Most beginners jump into a trend too early or too late. Your job is to wait for confirmation. A strong trend feels obvious, not stressful. If you feel tension or doubt, the trend isn't ready yet. Waiting for a pullback is your real entry strategy. Your best entries come during pullbacks, not breakouts. Breakouts attract emotional traders. Pullbacks attract patient traders. When price pulls back to a known zone and slows down, you want to see smaller candles, weak opposite volume. Price respecting the trend structure. This is where the safest and most logical trades happen. 5. Risk management makes or breaks you. This is the part beginners ignore, and it's the reason they blow accounts. Before you open any trade, decide how much you're willing to lose, where your stop loss must be, where the trade becomes invalid if you can't accept the loss before clicking buy or sell. You're not trading, you're gambling. Strong trading is not about winning more. It's about losing the right way. 6. One good trade a day is enough. You don't need 10 trades. You don't need constant action. One high-quality trade a day can grow your account over time. Watch the chart. Wait for your setup. When everything aligns, execute calmly. Patience is your real edge. 7. Common beginner mistakes you must avoid immediately. These mistakes destroy new traders faster than anything else. Entering trades because of fear of missing out. Trading during choppy sideways movement. Moving stop loss after entering. Overtrading after one loss. Using too many indicators. Trying to predict instead of reading the chart. Each one of these is a trap. Stay disciplined and avoid them from day one. 8. What you should be able to do after part 2. By the end of this stage, you should be confident in preparing your chart before the market opens. Marking clean and meaningful zones. Identifying strong, healthy trends. Choosing pullbacks instead of chasing breakouts. Placing smart stop losses. Taking only high-quality trades. Controlling emotions and sticking to your process. If you reach this stage, you're no longer a beginner. You're becoming a structured trader, someone who understands the market instead of reacting to it. Advanced entries, exits, and improving your win rate. If you've reached the point where your preparation is solid and you are consistently identifying trends and clean zones, it's time to level up. Part 3 is where we transform knowledge into repeatable execution. 1. Understanding high-probability entries. Not every pullback or trend is worth trading. Your edge comes from high-probability setups. Focus on setups that have: Number 1. Trend alignment. The overall trend must support your trade direction. Number 2. Key zone confluence. Support, resistance, and previous volume spikes should align. Number 3. Candlestick confirmation. Look for reversal signals or rejection wicks in pullbacks. Number 4. Volume confirmation. Trend continuation is more likely when buyers/sellers show strong participation. This is how professional traders separate good trades from losing trades. 2. Entry confirmation techniques. Even after spotting a setup, waiting for confirmation increases your probability. Micro pullback. Price briefly touches your zone and forms a small rejection candle. Momentum shift. A sudden acceleration in the direction of the trend. Multi-time frame alignment. Check a higher time frame chart to ensure trend consistency. The market rarely moves perfectly. Confirmation reduces false entries. 3. Smart exits. Protect your profits. Many beginners focus only on entries. A strong exit plan is just as important. Consider 3 types of exits. Point 1. Target-based. Predefine your exit using a key zone or Fibonacci level. Point 2. Trailing stop. Lock in profits as price moves in your favor. Point 3. Partial exit. Close part of your position at a target, leaving some to ride the trend. By controlling exits, you can turn a single trade into multiple profit opportunities. For position sizing and risk adjustments. This is where math meets psychology. Decide risk per trade as a percentage of your account, usually 1 to 3%. Adjust position size based on volatility of the market and distance to your stop loss. Avoid over-leveraging. Small, consistent gains are more sustainable than risking everything for one trade. Example: if your stop loss is 2% away from entry, adjust your trade size so that the 2% risk equals 1% of your account. Discipline in position sizing ensures survival in losing streaks. 5. Improving your win rate over time. Even the best traders lose trades. The difference is expectancy, not perfection. Expectancy equals average win times win rate, average loss times loss rate. To improve expectancy, focus on setups with historically higher win rates. Track every trade in a journal with entry, exit, and reasoning. Review mistakes weekly. Learn patterns of recurring losses. Avoid revenge trading after a loss. A well-documented strategy lets you refine and scale. 6. Combining process with psychology. By now, you should understand the charts, zones, and risk. But your mindset still dictates outcomes. Accept losses as part of the process. Avoid emotional entries. Stick strictly to your plan, even if a trade feels tempting. Celebrate process wins, not only monetary wins. A calm, methodical trader can survive months of small losses while building long-term growth. 7. What you should be able to do after Part 3. By completing this stage, you can identify and confirm high-probability entries, place trades with precise risk management, plan exits in advance, and protect profits, calculate expectancy, and improve your strategy over time. Remain disciplined, patient, and confident regardless of emotions. At this point, you are no longer just a beginner or intermediate trader. You are a structured trader who understands the market mechanics, respects risk, and executes with clarity. Real-time application, strategy testing, and scaling trades. At this stage, you are a structured trader. Now it's time to put everything into action, testing your strategies in real time, analyzing charts with clarity, and scaling your trades without emotional interference. 1. Simulated trading before real money. Even experienced traders use simulation before risking capital. This ensures your process is solid. Open a demo account or paper trading setup. Apply your high-probability setups exactly as you would in real trading. Track entries, exits, stop losses, and profit targets. Review trades daily to identify mistakes or missed opportunities. Simulation removes emotional pressure and helps internalize your process. 2. Bar replay and historical testing. A critical tool for improving your edge. Use bar replay or historical chart data to replay previous days. Apply your strategy as if trading live. Note what worked and what didn't. This allows you to refine your strategy without risking money, and you'll start seeing patterns that only appear over repeated trials. 3. Structuring your trading session before the market opens. Point 1. Review the overall trend for the day. Point 2. Mark key support and resistance zones. Point 3. Identify potential high-probability setups. Point 4. Decide your maximum trades for the day. During the session, stick to the plan. Only enter trades that match your predefined criteria. Avoid FOMO trades and impulsive decisions. After the session, review every trade in your journal. Analyze wins and losses. Identify opportunities to refine risk or timing. For scaling your trades strategically. Once you are consistently profitable in small trades, gradually increase position size. Ensure risk per trade remains consistent relative to account size. Consider leverage only after mastering size management. Scaling is not about going bigger too quickly. It's about growing your account while maintaining process discipline. 5. Real-time example. Step-by-step execution. Point 1. Spot a pullback into a key zone. Point 2. Confirm the entry with candlestick structure and volume. Point 3. Calculate risk. Determine stop loss and position size. Point 4. Enter the trade calmly. Point 5. Monitor the trade. Trail stop if necessary. Point 6. Exit partially at a target and ride the remaining portion. Point 7. Record the trade in your journal with all details. By following this step-by-step, you remove guesswork and emotion, making each trade part of a repeatable system. 6. Journaling and performance tracking. Your journal is your best teacher. Include date and time, asset and time frame entry, stop loss, and target trade outcome. Notes on psychology and mistakes. After several weeks, you can analyze patterns. Which setups win consistently? Which zones are more reliable? How your emotions influence decisions. This turns subjective experience into objective improvement. 7. Long-term mindset day trading isn't about hitting a jackpot in one session. It's about consistent, repeatable process risk management and capital preservation. Improving edge over time patience and discipline. Even a structured trader faces losses. The difference is losses are expected, controlled, and part of growth. 8. What you should be able to do after Part 4. By the end of Part 4, you can apply your strategy in real time, confidently test and refine your trades without emotional interference, scale your trades while keeping risk consistent. Maintain discipline and follow your plan regardless of market noise. Use historical data to improve future performance. Track and improve your results systematically. At this point, your trading isn't just a hobby. It's a repeatable, disciplined practice that can scale and grow over time. Advanced risk, reward, multiple setups, and long-term growth. Asterisk asterisk. By this stage, you've become a structured trader, executing trades with clarity, discipline, and confidence. Now, Part 5 is about optimizing strategies, managing multiple setups, and planning for long-term growth. 1. Advanced risk, reward management. Your edge is not just about picking winners. It's about maximizing reward relative to risk. Target setups with at least 2-to-1 or 3-to-1 reward-to-risk ratio. Adjust position size according to volatility and stop-loss distance. Always know maximum potential loss before entering. Combine multiple trades carefully. Total risk across all positions should remain within account limits. This ensures even a lower win rate can still generate consistent profits. 2. Managing multiple setups. A professional trader rarely trades only one asset. Maintain a watch list of 5 to 10 assets with high liquidity. Prioritize setups based on probability and clarity. Enter trades only when all conditions match your strategy. Avoid overtrading. Quality beats quantity. Multiple setups allow you to capitalize on more opportunities without increasing risk recklessly. 3. Intraday strategy variations. Market conditions change daily. You need flexibility. Point 1. Trend continuation trades. Ride strong momentum in the direction of the trend. Point 2. Pullback/reversal trades. Trade corrections within a trend with high probability zones. Point 3. Breakout trades. Enter when price breaks key support/resistance with confirmation. Point 4. Mean reversion trades. When price moves too far, look for retracements to fair value zones. Switching strategies based on market context increases your adaptability and profit potential. 4. Portfolio and capital growth. Once your daily trades are consistently profitable, scale up account size gradually. Never risk more than a small percentage of total capital. Diversify across crypto, stocks, or indices if your strategy supports it. Reinvest profits systematically instead of withdrawing impulsively. Track growth over months, not days, to avoid emotional overreaction. Sustainable growth comes from compounding small, controlled wins. 5. Long-term mindset and discipline. Day trading isn't a sprint. It's a marathon of consistency. Accept losing streaks as normal and maintain proper risk control. Keep your journal updated. Analyze every trade. Review monthly metrics: win rate, average risk, reward, total profit/loss. Continuously refine your process. Adapt, but never abandon your proven rules. This mindset separates hobby traders from professional traders. 6. Using your trading journal for optimization. Your journal now becomes the ultimate tool. Identify which setups work best for you. Measure which times of day yield the most consistent results. Track psychological patterns. Know when fear or greed is affecting decisions. Adjust rules gradually, based on data, not emotion. Over time, this makes your trading scientific rather than speculative. 7. Summary. From beginner to professional trader. After completing all 5 parts, you should be able to: Point 1. Read charts confidently and understand market mechanics. Point 2. Identify high-probability entries and plan exits precisely. Point 3. Manage risk using advanced math and position sizing. Point 4. Test strategies in real time and adjust based on performance. Point 5. Execute multiple setups with discipline. Point 6. Scale your trades and grow your account sustainably. Point 7. Maintain a long-term, process-driven mindset. At this point, trading becomes a repeatable, disciplined, and scalable practice. Success is no longer a matter of luck. It's a matter of process, execution, and consistency.
Hello friends, how are you? Welcome back to my another video. If you are completely new to day trading, the first thing you need to understand so these people don't lose money because trending is impossible. You lose because they jump in the without knowing what they're actually doing. Day trading is a skill, and like any skill, it demands patterns, structure, and real understanding. Let's break the foundation in a way that actually makes sense. Okay, number one. Number one, what day trading really is. Day trading simply means buying and selling within this same day. You are not investing, you are not holding for weeks or months. You are trying to catch short quick price movement that can last a few minutes or a few hours. Think Think of it like surfing. Their waves prices move fast. If you don't understand the rhythm, you will fall hard. Your job is not to fight the market, your job is to read it. Number two, what makes prices move? Before you even touch a chart, you need to know why the price move up or down. There are only a few real reasons. Buyers are stronger than sellers, price goes up. Sellers are stronger than buyers, price goes down. Both are equally strong, prices become choppy and unpredictable. So friend, this is my today videos. So please like my video, subscribe my channel, and press the bell icon. Thank you so much.